Welcome to ArthaX Finance, your trusted partner in simplifying global finances. In the last video, we discussed about long-term capital gains and how taxes worked for Indian residents and NRIs for equity and equity-oriented mutual funds. Today, we will discuss about short-term capital gains, which is also called as STCG, and how the taxes actually work for Indian residents and NRIs. First and foremost, we have to understand the criteria for short-term capital gains. If you sell your shares or equity mutual funds within 12 months from your purchase date, then the gain is treated as short-term capital gains. Then comes the tax rate on those gains. According to section 111A, the concessional tax rate of 20% is applied on the gain only on those transactions that are executed through a stock exchange and STT is paid. However, there is one exception to this rule. The concessional tax rate also applies even if STT is not paid. If transaction is undertaken on a stock exchange located in any IFC and amount is paid or payable in foreign currency. We will understand this with a simple example. Let's say you invested 5 lakh rupees in Chola Finance on 3rd of June 2025 and sold on 11th of December 2025 worth rupees 7 lakhs. Since the shares were sold within 1 year, it will be treated as short-term capital gains. The total gain over here is 2 lakhs. Thus, you pay 20% tax, which is 40,000 rupees plus additional 4% cess, which is 1600 rupees. But do you know you can still save rupees 40,000? That's the most important point which many people miss. You can use basic exemption limit to reduce your short-term capital gains and the tax on it. Now the basic exemption limit depends on individual age. Look at this table below. Now under the old regime, if any individual who is less than 60 years, the basic exemption limit is 2.5 lakhs, which increases to 3 lakhs if that person is between 60 to 80 years old. Super senior citizens, it is 5 lakh rupees. However, under the new regime, it is 3 lakh rupees, irrespective of the age of the individual. However, for NRIs, the basic exemption limit is rupees 2,50,000 under the old regime and 3 lakh rupees under the new regime, irrespective of the age. Another important point to note, this basic exemption limit applies only to Indian residents, and non-resident Indians cannot use this basic exemption limit to offset their short-term capital gains and its tax. Now we have all the details. Let's understand with two examples to make it crystal clear. We call the person as Keshav, an Indian resident 65 years old. He has no other sources of income. He invested 8 lakh in Nifty Midcap 150 index funds in January 2025 and sold in December 2025 for 11 lakh rupees. Now let's calculate his gains and how much tax he has to pay. The first step is to calculate his holding period. In this case, which is less than 12 months. Thus, he qualifies for short-term capital gain tax. Now look at the table to calculate his tax. The purchase value was 8 lakh rupees. He sold it for 11 lakhs, thus making the short-term capital gain of 3 lakhs. But still, he doesn't have to pay tax because he can use the basic exemption limit, which is 3 lakh rupees, because he is more than 60 years old but less than 80 years old. Thus, his taxable short-term capital gain tax will be 0. Now let's take another example. What if Keshav was a non-resident? How will his tax liability change? We'll keep the same details. Now look at the table. So now we have a purchase value of 8 lakhs. Sale value is 11 lakhs. Now his short-term capital gain is 3 lakhs. Now here, being a non-resident, he cannot use the basic exemption limit to offset this short-term capital gains. Thus, he have to pay 20% tax, which is 60,000 rupees, plus 4% cess on short-term capital gain, which is 2,400. So Keshav has to pay the total tax of 62,400 rupees. Now you have clearly understood how does taxes work on short-term capital gain for equity and equity-oriented mutual funds. But it is best understood when you do the practice on your own. I will give an homework which you can do and it will help you a lot. Radha is a retired 70 years old bank manager from Bank of Baroda. She receives monthly pension of rupees 30,000 and in the same financial year she sold ITC shares with short-term capital gain of 90,000 rupees. Now calculate her short-term capital gain tax. Drop your answer in the comments. In the next video, we'll discuss about taxation on debt funds and securities. Thank you.